So thank you all very much for joining. Welcome to this TMI and Diginex webinar. I'm Eleanor Hill, editor of TMI, and I'll be your moderator for this session. Today, as you know, we'll be discussing crypto assets and their suitability as a treasury investment. And we've got a wonderful panel absolutely raring to go. So welcome Richard Byworth, CEO of Diginex, Dr. Carsten Sorensen, who's Reader Associate Professor in Digital Innovation from the LSE, Henry Arslanian, who is Global Crypto Leader from PwC, and Francois Masquelier, who is CEO of Simply Treasury. So welcome all of you. Before we kick off, just a few housekeeping points. You can submit questions as we go via the Q&A function at the bottom of the screen, and there'll also be a few polls popping up on your screen throughout the session, so please do participate. We'll have a session for questions towards the end, but as I said, please keep them coming throughout, and we'll try to address as many of those as possible. So without further ado, let's kick off. It would be great to start with a little bit of the macro picture as to what's going on in the crypto asset world and why is this happening now. So Carsten, would you mind giving us just a brief little bit of background on crypto assets and how the digital infrastructure supporting them has evolved to enable the situation of where we are today?
Yes, of course. Thank you very much. It's a pleasure to be here. Now, in the good old days of the 2000s and until quite recently, you had a fundamental choice. If you wanted to exchange something that had value to you with somebody else, you could either send it via a direct credit card payment to somebody you didn't know and potentially be scammed, or you could, to put it bluntly, give all the data to Google or Facebook. So the whole point of the traditional internet only knows about data. It doesn't know about value and rights. So the only way we can exchange things with these digital rights with each other is to use a trusted third party. Now, the point is here that the ability of a blockchain arrangement, or generally a distributed ledger, is to allow a community to agree on what the rules are for how you link digital rights or value to a railway network. So instead of the £10 note being shipped on all sorts of different infrastructures, we agree on which particular infrastructure we use. And what this allows us to do is to have this perennial problem since the global digital platforms were emerging since 2000, is really to have a much more flexible way of both companies and individuals to exchange digital rights. So what we've seen quite recently is that these kind of arrangements used to be on the fringes. It was when I bought a bit of Bitcoin in 2011, it was only computer scientists or people who are on the inside that would do this. Whereas now we are trying, in the same way as the internet was integrated in the rest of society around 2000, we are now trying to integrate these things in institutions that are beyond the digital infrastructures themselves. And I think we have literally just begun this journey.
Yeah, absolutely. And don't still have those Bitcoin, Carsten, do you?
I'm crying every night. No.
Good stuff. Richard, tell us about the economic drivers behind crypto assets gaining so much traction right now.
Thanks, Eleanor. And again, great to be here. So thanks for having me. Yeah, I think most people have become aware of the global macroeconomic backdrop that we're seeing that's really propelling digital assets to the fore, predominantly Bitcoin, as the store of value within the crypto asset space. So since the pandemic effectively, encompassed the world in March 2020, we've printed 40% of all the dollars outstanding. Now, if you consider that against the backdrop of how many dollars were printed per year in a normal year, you'd have a normal run rate, even in the extreme QE times that we saw in 2008, of not even 10% of new dollars. Here we've gone 40% of new dollars, and it's just a remarkable effective devaluation of cash piles. And we're not going to stop that process. Any democratic leader right now has a choice: go austerity and start saving money and making sure that we can start to pay our bills, but that's always going to be a challenge, given the growth requirement for the debt burdens of these nations is just too high. So you're looking at something like 4 times global GDP of all debt, including sovereign and corporate.
Yeah.
So servicing that debt is requiring an enormous amount of money to.
I think we've lost Richard there for a moment. So Henry, let me bring you in, because one of the topics in this area. Sorry, Richard, are you back? Or Richard, we lost you there for a moment.
Hi, I'm with. Can you hear me?
Yeah, we can hear you. Sorry if you want.
Sorry about that.
That's okay.
Yeah, so you've got an added problem that effectively everything that's happening in the world around technology is extremely deflationary. So if you look at the phenomenon of self-driving cars that are getting closer and closer with Tesla, Google, Uber, everybody having their various different projects, you're going to get to a point where owning a car will be, you know, something that you potentially make as an investment, and you actually loan that car out within the network, and it chauffeurs people around all day until the point that it has to come and pick you up from work or wherever it is that you might be going. And that's going to put an enormous amount of people out of work as well. So the GDP problem, the growth from jobs that all central banks are going to be needing to try and fuel to keep GDP to a level where it can service debt, is actually getting pressured downwards. So the freeness of that button pushing by Biden and obviously the Fed, but Biden behind them, you know, continuing to want to stimulate the economy and try and drive growth, but even if they don't drive growth, devalue the money enough that the debt burden is not so high, then you can kind of see where all of this is going. And Bitcoin, particularly as a crypto asset, is an asset that, when you look at it against things like gold, scarcity, divisibility, portability, verifiability, durability, Bitcoin actually smashes gold on all those factors. This is why it's being considered as a store of value, and as Carsten points out, a beautifully digital store of value, which was created in the first implementation of Bitcoin and blockchain as a broad technology. And so this is where we are. You know, the bigger, broader reason that we're going to continue seeing this money printing is that just overwhelming debt burden. So it's really not going to stop, and that's where we are today.
Excellent. Thank you ever so much. So Henry, bringing you in, Richard mentioned central banks there, and obviously the central banks are very busy with their digital currencies as well. So why has this become such a hot topic now? Can you give us some examples of the pilots happening, and, you know, why treasurers should be paying attention to this?
Absolutely. First of all, thanks for having me. Thanks for everybody listening for giving us an hour of your time on this. Absolutely. As was mentioned today, if you're a central banker and you love Bitcoin, you're crazy. It's a bit like a taxi driver being excited to see Uber come in their market. Of course, central bankers are not stupid. They realize there's a lot of benefits of digital currencies that they can use themselves. And this is why today, as we speak, according to the BIS, 86% of central banks are looking at CBDC, central bank digital currencies. So what is a CBDC? Today, Bitcoin is fully decentralized. There's 21 million Bitcoin ever. Nobody can control it as much as the Fed may want to. When it comes to CBDC, it's a digital currency that is issued by the central bank that becomes part of the monetary base of a country. And that is very relevant for treasurers on the line. As we all know, if we go to, I put my professor hat on for a second. Today, there's 2 kinds of central bank money that we have. One is good old banknotes, which is liability of the central bank that we all hold. Second are the reserves at your lovely bank, that where you have all your assets is holding at the central bank. The money that you as a treasurer you have at your lovely bank is not central bank money. And what is really exciting is all of us, everybody listen to this session today, in our lifetime, we will see the appearance of a third form of central bank money, kind of digital banknotes, which is basically retail CBDC. But you may ask, why are central banks doing this, right? A couple of reasons. One of them, from a monetary policy perspective, if I'm using cash, there's no way, it's very difficult for a central bank to have a good economic activity of what is happening with cash. And this is why in many countries, by the way, Germany, sorry, not Germany, especially Italy, Greece, and others, 20% of payments are happening in cash. It's a good way to evade taxes. It's a good way actually to not let people know what you're doing with it. With a CBDC economy, the government can know pretty much what is happening. Second, it also gives us a fighting chance against money laundering. Today, if you want to buy drugs, you want to do something illegal, cash is still the best way. And actually, when we move to a CBDC economy, governments and policymakers we have a fighting chance to put an end to money laundering and other bad activities that we're seeing. And there's many other reasons like these, you have better monetary tools and so on and so forth. So CBDCs will happen. There's really two kinds. One is a wholesale CBDC, which is between the central bank and the member banks. That affects the banks, that affects the central bank. The retail public does not see it, although it may have an impact as you as a treasurer because of it can potentially reduce your costs. But also there's what it probably is more important is retail CBDC, which is digital currency issued by the central bank that the public is able to hold. There's a whole suite of events going on. I won't go into it, but I think suffice to say today, when it comes to wholesale CBDC, which is a central bank and the member banks, probably what's happening right now between Hong Kong and Thailand is probably the most advanced. PBOC, the People's Bank of China, joined it, and the UAE. I'm actually in Dubai right now. Has joined as well, where we're seeing a real first-time multi-currency wholesale CBDC initiative. And when it comes to retail CBDC, here, there's no doubt, by far the country that is the most advanced here at scale is China. China is probably 5 to 6 years ahead of any other country in this topic. The PBOC has been researching it since 2014. The Bank of England launched a research project on this in March 2020. Chinese have been looking at this 2014, is years ahead of anybody else on this. So if you want to look at this area, keep an eye on what's happening in Asia. I'll pass it back to you, Eleanor.
Excellent, Henry. Thank you so much. So, Francois, let me bring you in here as probably what our listeners think of as the voice of reason from the Treasury community. So, to what extent do you think that the sort of marketing machine and stories in the news like Tesla are driving Treasurers' interest in crypto assets right now?
Yeah, no, it's interesting times. So it's right to say that there is a sort of crypto mania for a couple of months now. And for different reasons, but I think that a lot of retail investors see opportunities to make easy money and push market up to unsell level, I think, and with high volatility. So I think that there is a traction and interest more coming from this retail side and from the corporate side. Although things are changing, I do agree. When these new virtual currencies will emerge is a question. It's not if they will come, but when they will come, I guess. And we know that it could come sooner than later. There is a conjunction of factors which concur to boost cryptocurrency at the moment, despite their intrinsic problem. And we will talk, I guess, and address the issues with cryptocurrencies. But the problem is how will these currencies, let's say, survive over time if we will have a consolidation, etc. So I know that we will have also some problem, and maybe some people will be, let's say, affected, penalized by the swing in terms of valuation. I also think that it's interesting, the central bank initiative mentioned by Henry are quite interesting and could maybe give more weight to the credibility of initiatives. If it comes from a central bank, of course, it's a different story than if it comes from a non-central banks. So I guess we need more rigor, more frame, more rules around that, because if not, we compare two different type of assets. And we can come to the question, is cryptocurrencies currencies or a new class of assets? That's a big one. As mentioned by Henry, he shows a note, and we see on the note, in God we trust. So we need to trust in the currency. It's quite important. And therefore, here's our traction, and the Tesla story and some others will push traction on the market, interest from corporate treasurers, although it just bring, in my view, at grist to the mills. It supports the case, as well as CBCD initiative will do, but still we are far from the level where we will use cryptocurrencies as we use, for example, money market funds. So we will see. But I guess we will address what could be the issues with currencies.
Absolutely. We will get into that very shortly. But before that, it would be great if we could look at some of the upsides and the potential there. So Richard, why might a treasurer actually want to invest in crypto assets today? Could you maybe talk us through the potential return profile of a Bitcoin investment, for example?
Certainly. So if we just actually to touch on something that Henry mentioned, Henry obviously talked about CBDCs. Now, the IMF themselves in 2018 put out a paper that explained to all global central banks the benefits of CBDCs. The benefits of having everybody locked in to their currency with nowhere to hide, as Henry said, in terms of cash, is that interest rates can go significantly below zero. And when you look at that comment that could have been disregarded in the report against the debt pile that I mentioned previously, you can see that this is very much the intention of central banks like the ECB and likely the Fed as well, to be able to control interest rates to go negative to such a degree that they can find another form of taxation. And, you know, to Francois's point, you know, people using money market funds, I don't think anyone really wants to be using money market funds these days. That's the problem, is the yields are just extremely uninteresting. Sure, they're super liquid, but, you know, how are you actually protecting your company's assets against this massive devaluation that's coming and is very clearly being signaled by institutions like the IMF and others? So, you know, sort of caveating the response to that first with that statement, I think that Bitcoin, if you look at it against something like gold, you know, and there are proponents out there that will say that Bitcoin is not only as good as gold, it's better than gold, and better than gold. You know, imagine, you know, an example of, I'll give you myself right now. My wife has moved to Switzerland. She has access to a vault for us in Hong Kong, which only she has access to. Because of the pandemic, she has no interest in traveling to Hong Kong, but we have a gold bar in that vault, and I don't want it in Hong Kong anymore. I want it in Switzerland. So just to give you an idea, even if I could get access to that vault, getting that gold bar from Hong Kong to Switzerland is a complete pain. And Bitcoin and the technology of Bitcoin actually allows that transaction to happen in minutes. So it's a very different proposition. The transfer of value, as I think has been covered by all the speakers, without any third-party interaction, is extremely important. But when you just match it against gold as a market cap, if Bitcoin were to achieve the same market cap as gold, then we'd be looking at about $550,000 Bitcoin price. Now, I don't think that's going to happen overnight. I think this is going to take time to play out. But you've already seen some very credible banks in the financial sector talk about the propensity for Bitcoin to achieve those sorts of valuations. Citibank came out with a $300,000 target. Morgan Stanley with around the same level, and I think a third bank, which I can't recall right now, came out with something around the 400,000 level. You know, Guggenheim, one of the most credible investors in the world, came out with a $400,000 target on Bloomberg very recently, back when Bitcoin was trading at 20,000. And I'm very much of that school of thought, where you have, you know, a stock to flow profile that you do with Bitcoin that is currently similar to gold. At the next halving in 3 years, it's actually going to flip gold. So you're going to have a very, very scarce digital asset that outperforms gold in just about every, you know, consideration of value storage. So my target for the year is 175,000, and very confident with that target. I think that we're going to continue to see Biden and others press that button and print more money, and it's only going to fuel Bitcoin in one direction.
Okay, I'll hold you to that, Richard. All right, Henry, let's bring you in. One of the other things that we hear about a lot in this space now is stable coins. So Are they a good investment opportunity for corporate treasurers?
Yeah, so obviously, like we talk about Bitcoin, which obviously decentralized, the value is offer and demand, as Richard mentioned, CBDCs, which is kind of part of the monetary base of the country. When it comes to stable coins, what is a stable coin? It's a digital asset that is backed 1-to-1 by fiat money. You may say, hey, what's the point of that then? Why would I even hold this? The benefit, if I send, for example, to you, Eleanor, a Bitcoin, you'll be very happy, but you don't know what the price will be a week, a month, a year from now. Whereas if I send you a stable coin, because it's a digital currency backed 1-to-1 by US dollar or any other fiat currency, by the way, you know what the value, at least in upfront, what the value will be from now. This is very important for treasurers for a couple of reasons. One of them, the biggest problem that stable coins are tackling is cross-border payments. For anybody on treasury side, you guys know not only how the fees you're paying every year, despite all the packages you're getting from your lovely banks, but also the user experience, which is frankly absolutely terrible when you're sending money overseas. The benefit with stable coins is that you're able to send money around the world 24/7, instantaneously, pretty much for no fees. And what's important with this is happening only at the retail level. Today, the average fee of cross-border fees is about 7%, and that's already happening around the world. But we're seeing increasing corporates send money to each other using stable coins. And I think that if you're a treasurer right now, this is actually something to look at, because first of all, let's say if you don't want to put Bitcoin on your balance sheet for any X reasons because of volatility or whatever it is, at least from this perspective, there's not only cost savings on your payments you're making, but also there's a lot of benefits even on the yield. I mean, to give you an example today, if I have any US dollar stablecoin, myself today as a retail customer, I'm able to get anywhere from 8 to 10, 11% of yield on US dollar stablecoins, which is something that is very, very, very far from actually people are able to get on the dollars at their banks. There's something to keep in mind from that perspective that could be quite useful. So again, even if you from a lot of efficiency and effectiveness issues, I think stablecoins should be on the agenda of any corporate treasurer as well.
Yeah, that's interesting what you said about corporates using them to send money to each other. So, Francois,
you could comment on that.
Let's get the corporate treasury opinion on this. So we'll talk about the downsides in a minute, but at this moment in time, do you think that the upsides of crypto assets are interesting enough to look at? What's the general feeling in the treasury community? We've just seen a little poll there, and I think about 40% said absolutely not, but there were some that were quite keen and some that were thinking about it. Is it too early for treasurers, or do we need to wait a bit longer? What's your thoughts?
Just to answer the last part of your question, it's maybe too early for treasurers. We need also, because we are quite conservative people, as you can imagine, so we are there to preserve the principle, to preserve the money and the cash and short-term cash of the company, and to ensure the payment. So by nature, corporate treasurers are quite conservative, and so it's a bit, let's say, antinomic with the with this kind of currency. So things are changing, but it will be a soft revolution, I guess, for many reasons we will discuss. However, I think that the momentum is there, and so to see the positive, let's say, aspect of the benefit of cryptocurrencies, because there are some, I think that first we need to take into consideration the new generation and the way this generation want to act. They would like to use new methods of payment, so it's quite important to take that into consideration. And I know a couple of companies who are considering using that as a way of paying their counterparties, their suppliers. Then we have the negative interest rate, or the zero interest rate in many hard currencies. So it's quite important, because we were there to preserve the principle, as I said, but now we are destroying the principle, like in Danish krona, in Swiss franc, in Japanese yen, in euro. So it's quite difficult. It's a bit also something that's difficult to swallow for corporate treasurers. So again, we need to find other alternative currencies or assets. But is a shift to cryptocurrency the right one? It's maybe too radical, I would say. I like the comparison from Richard when he talked about gold, because everyone has in their own portfolio maybe some gold as a sort of protection, especially in crisis time. But I view cryptocurrencies as a sort of different class of asset, and I like the comparison with gold, although it's completely different. So again, there are some positive aspects, and we need to live with our time and take into consideration the new generation.
Yeah.
But again, we have also the downside that we need to bring answers to. That's
Yeah,
don't know.
absolutely. Treasurers do need to be conservative. That is part of the job. All right, let's talk a little bit more about the considerations, potential downsides, and maybe concerns that some of you in the audience have. So, Carsten, one of those is obviously going to be the regulatory landscape around this. So, would you mind giving us a little bit of a view of the current and future regulatory situations surrounding crypto assets? And is it strong enough, really, that regulation for corporate investors to feel comfortable, do you think?
Well, again, I would draw back the comparison to what happened in around 2000. So right now, countries around the world are trying to work out how to regulate Google and Amazon, how to understand this emergence of these digital platforms and the power they have over, for example, our politics. And so the point is that the same process is going on within the world of crypto, where in the same way as the early web days, people said it'll be retail, it'll be e-commerce. And it wasn't. It was B2B. It was all sorts of other corporate use that turned out to be the most important at first. Now we've seen the high street being slaughtered by e-commerce. But the point is here, in the same way, Bitcoin was sold as this is perfect C2C transfer of money between individuals. But the real impact will almost certainly be on the corporate side. There's so much more advantage there that this will drive the process. So the challenge we have is, well, there's lots and lots of challenges. As the best example is the current case against Ripple, which basically has illustrated that you have a very fast-moving, a radically innovative world of crypto that is digital innovation. So it moves extremely fast. And then you have a regulatory world that's trying to come to terms with what is happening here. And I think this idea of the US regulation has to change. Otherwise, this will be a problem, simply because, you know, American citizens cannot engage in an ICO. They can't even do crowdsourcing because of the regulatory environment. And so the problem we have here is that there will be regulatory divergence between countries in order to ensure their competitiveness. This is why, of course, everybody is trying to tool up on all these aspects. And the reason is, of course, that crypto is global. You can't just tie it down to individual legislative restrictions or restrictive areas. So it's absolutely clear to me we are at the early stages of the regulators trying to understand that if you need to regulate crypto, the essence of it is digital. So what is a utility coin for one person claiming is actually a share in a company for another, and it really depends on what happens when you spend it. So the Howey test is not working anymore. And the reason for that is we're dealing with digital innovation. And so regulators need to understand what goes on under the hood. And they have, at least in the UK, refused to do that largely. And I think this will be a big challenge.
Oh, absolutely. A huge challenge going forward. We've got a lot of great questions coming in. We will get to those very shortly. Just finish off talking about some of the considerations. So, Henry, how easy is it to enter and exit crypto assets? Are they sufficiently liquid for treasurers to feel comfortable? And are there any kind of resource burdens, tech requirements on the corporate side?
Yeah, great question. Well, I'd say first, I think let's look at two sides, right? I would say buying and selling or holding crypto has never been easier as it is today. I mean, first, let's look at the retail side, just to put things in perspective. In 2016, there was only 5 million people with an account at a crypto exchange. In Q3 of last year, before the whole bull run we had, there was only over 100 million, or probably double that right now. Right now, you can see platforms from PayPal and others. It's very easy for retail people to use it. And if you want to use regulated platforms like Diginex, for example, great examples that you can go and easily sign up and actually be able to access it. When it comes to corporates as well, again, compared to 2-3 years ago, there are now numerous regulated platforms that are very easy to actually be able to buy and sell and hold crypto. The number of these players are regulated. They have SOC 1, SOC 2 compliant reviews being done. So I think from an operational perspective, that box is ticked right now. Frankly, that should never be an excuse for any corporate treasurer. The way I recommend to everybody, and I had this conversation with many treasurers of companies, either public or private, there's two things that I recommend to everybody. One is education. Spend literally an hour of your time. You don't even need to read the Bitcoin white paper. There's tons of YouTube videos. There's tons of information. You can even watch my own YouTube channel if you want. There's a lot of educational content out there to read and learn about it. Second, open an account yourself. open an account yourself, put $10, learn how to trade, and actually just experiment how it works, and you will realize some of the benefits yourself. And often that's often a good way before bringing it to a corporate level, also makes them more knowledgeable. And maybe last is often what I find with a lot of corporates, especially those on the treasury side, especially Francois was very polite saying that they were very traditional. We called old school or legacy in the crypto space. I think one thing to look at is often there's a lot of young people who are very knowledgeable on this. Ask the youngest member of your family or ask the youngest member in the organization. You'd be surprised to see how knowledgeable they may be on crypto, and try to bring the expertise that you probably already have in house or within your family. And that's often a good way. And once you've done these steps, often then you can make your own decision of putting either Bitcoin or cryptocurrencies or stablecoins on your treasury, on your balance sheet is the right decision. And hopefully then you can make a decision then.
Some brilliant advice there, Henry. Thank you so much. So, Richard, one of the other questions that we often get is around the custody arrangements that are available for crypto assets and how secure these are given the rise of cybercrime. So could you possibly weigh in on that, please?
Yeah, certainly. I think, I use the analogy that Mike Tyson said. We're seeing a little bit of complacency around security, certainly within the crypto community right now. I think that's different for institutions, but I always say that using that Mike Tyson analogy, everyone has a plan until you get punched in the face. Security doesn't matter until it does. And then it is the most important thing on everyone's mind. So, we've designed our custodian DigiVault to adhere to the highest standards. Risk policy engine designed to be integrated with institutions. It's CREST certified. It's Cyber Essentials Plus accredited. That's a Ministry of Defense level accreditation for cybersecurity. We have insurance. We've partnered with one of the largest physical vault providers in the world, Malka Amit, that do diamond and gold bar vaulting across the world to provide physical vaults for the storage of those keys once we take them offline. So to your question, it's always the first thing that an institution or a corporate needs to consider is how am I dealing with my custody? And obviously by having a partner like ourselves that is under the foresight of the FCA in the UK, with vaults globally, we're able to stand up vaults in Singapore, Hong Kong, Switzerland, most other major financial jurisdictions. It allows people to have flexibility and obviously have the backing of a NASDAQ listed company and Diginex behind that. And I think all of these things end up being tick boxes for people around that security element. For us, is the most important thing. The team actually comes from the Ministry of Defense in the UK when they were responsible for domestic security solutions for the UK government. So they have a very rigid protocol, process, and way of operating their custody. I'm more than happy to go into detail with people around that as and when questions arise. I don't know, I would like to make one point, and it was a very good question that you made to Henry, and Henry pointed out an extremely important aspect that I think we should drill into for just a moment for corporate treasuries, is that yields on stable coins are at that sort of 9-10% level. Now, a lot of people will look at that and go, okay, that's just a weird thing about crypto, but actually it's not. And it's telling you something about where real interest rates probably should be. When I mentioned that debt pile before, if you assess that the average interest rate on that 4 times GDP debt pile is about 3%, you can quickly calculate that real interest rates are equating to about 12%, because you've effectively got that leverage component of 4 times within that 3% interest rate. So what we're seeing is that actually these dollar funding rates are being funded or created by people that can't get access to capital, but are collateralizing these loans with over collateralization in Bitcoin. And these over collateralizations are managed very tightly on a margin schedule. So it's really risk-free returns in terms of the collateral that's being managed on pure dollars at that sort of 10 to 12% rate that Henry mentioned. And so this is actually really important. Francois talked about money markets. you don't want to be investing in money market funds right now. You want to be taking dollar assets and getting those sorts of yields on it. So it's very interesting. We are seeing federal banks start to get into this space and actually lend money into the stablecoin market. So it's being taken very, very seriously.
Great point, Richard. Thank you so much for that. So, Francois, just a quick question, and then we'll get to all of our audience questions, which are coming in nicely. So thank you very much for those. Keep them coming. Francois, when we think about all this from the Treasurer's point of view, what challenges do you see around Treasury policy, accounting, tax, internal issues, reputational risk? What are the big things in your head that kind of go, oh no, this is very, very difficult for us?
No, as you rightly say, so there are many challenges. You mentioned some of them. So one of the priority, as mentioned earlier, is the security. So it's quite important for us because we have payment factories. So we have secured the payment. We have paperless processes in multinational companies. So it's quite important to ensure that and to have strong internal control. So the security is really something that we need to get a real grip on and to make sure that it has at the level of the standards we used to apply in Treasury. You mentioned accounting. Accounting, it's an issue on the IFRS because if you create some P&L volatility, if you consider that it's trading, depending on the, let's say, the discussion with the auditors and the purpose of this investment, but if it's short-term investment, the trading and the P&L impact could affect your result. And again, for traders, it's difficult to explain because you know that we are not people, let's say, remunerated or incentivized by the performance on the excess cash return. So we don't want to take this kind of risk. Taxes maybe could be an issue. Of course, the volatility of the currencies and which one, because you have so many cryptocurrencies, so it's difficult at the moment to find your way. So we can maybe wait for consolidation of the market. Education, it's an interesting point mentioned by Henry, I guess. So we need to educate the management, educate our teams, but also educate our CFO and the C-level and the audit committee that it could be an alternative investment. Of course, I think that it should be a reasonable investment depending on the proportion of your asset. So 1.5 billion of Tesla was a bit impressive in my way. We need also to change our policies, internal policies. Another issue is the fact that for us, usually a currency should have certain interest, even negative at certain moment in time. But if you don't have interest, it's look like an asset like gold, and so you just can gain in capital or lose in capital. Hedging, it's also an issue when we have an asset, a currency we use and we love to at least try to protect our assets or to find direct or indirect way to protect the assets. So the kind of issue we may face. So a cultural issue, a cultural resistance to the changes, a cultural resistance because of maybe unknown part of this cryptocurrency. It's too new for a lot of people. But if we can, let's say, circumvent and sort out this problem, especially in terms of automation and integration into our payment system to make sure that it's secured, of course, it could be an interesting asset we will certainly have to use to collect or to pay our supplier and customers.
Excellent stuff. Thank you, Francois. So, time now for audience questions. We've got absolutely loads of them to work through. We will try to answer as many as we can. If there are ones that we can't get to, we'll try and get back to you offline. There's a definite theme here, which is ESG. There's about 3 or 4 people that have asked about this. Where do crypto assets sit within the ESG space? Are they a bit of a no-no given that Bitcoin uses so much energy behind the scenes? So Richard, is that one that Henry maybe you could comment on as well?
Very happy to. So yeah, it's a question that we get a lot. The obvious question around electricity usage of the Bitcoin network. There's a new article just about every month about a different country's level of electricity usage now matching that of the Bitcoin network. And I can speak from experience. We used to be a mining company. It is not efficient to be mining with anything other than clean energy. We mined in 3 different locations globally: Switzerland, China, and northern Sweden. And in every case, we were using hydroelectric power that had been generally orphaned from the national grid and was not able to be used broadly by the public requirements for electricity. This is the interesting point. And actually, there is a strong school of thought that makes the proposition that actually Bitcoin will help drive the growth of efficient and clean energy. To be a Bitcoin miner, you cannot be inefficient. You need the best machines, tweaked to the best capacity. You need the best source of electricity, i.e. the cheapest, and you need to be in a cold location, and you need the best facility infrastructure. If you fail on any of those points, you become less competitive than other sophisticated players on the network. And this is a really important point, because what does it mean? It means that, an example, a landowner in Texas that has a load of non-utilizable land miles away from any national power grid is now incentivized to actually set up a solar panel farm, because he can actually sell that electricity to a Bitcoin miner. And this is really important. It suddenly creates a sustainable network of clean energy. No one is mining Bitcoin with coal unless they're somehow getting a cheap deal, which we are seeing examples of in China. But more and more, they're getting pushed out by these much more efficient energy players. And longer term, this is driving to more efficient energy and clean energy networks. And I see Henry nodding. I'm sure he's got something to add here.
Oh, that's interesting. Yeah,
sure.
Henry, go on.
Yeah, just happy to add. Richard's absolutely correct on some of these elements mentioned. The other thing I would mention as well is that today Bitcoin is using proof of work, which is the energy intensive, consensus mechanism, and we are moving to proof of work. Ethereum, which is the second biggest currency, over the next 24 months, for example, is migrating to proof of stake, which consumes a fraction of the electricity. Second point, I just want to make sure. I think we need to compare apples with apples, right? People compare Bitcoin mining to the Visa network, which is a centralized payment system. I think we should compare Bitcoin mining with gold mining. So if you look at the data that is there independently out there, gold mining, again, depending on the source you look at, is often 50 times more polluting than Bitcoin mining. A wedding ring that you have, that we all hold, that we nobody thinks about twice, may consume up to 20 tons of waste. Even the World Gold Council acknowledges that in order to reach the Paris climate agreements, the level of waste by the gold industry needs to go down 80%. So it's very interesting for me when we think about ESG. I never see this topic come up when it comes at the investment committee level with any allocator, which is something I think we should think about from this perspective. We all look at gold, but I think we have to compare apples with apples from that perspective. And the last point I think that Richard hit on is very, very relevant, is that there's a lot of, often the Bitcoin miners are acting as a buyer of last resort. Let's not forget, Bitcoin mining is 24/7, goes around the clock. They're often next to the source. Where I come from, in Montreal, Canada, in Quebec, where you have these big hydroelectricity dams, often these miners are going next to it and actually buying electricity that we've otherwise wasted, or often that are able to buy it when it's a downside and there's not enough demand. So I think we have to be honest. Yes, Bitcoin is not a green asset. It consumes electricity, but at the same time, it's not as bad as mass media, like any other debate. We have to take an intellectual approach and look at both sides of the dilemma.
Absolutely. And you look into anything, there's all sorts going on behind the scenes, like the lithium batteries with the cobalt mining and the child labor, and there's an awful lot to think about. So another question: how do you ensure any Bitcoins held have no criminal or money laundering history? If you'd like to take that. Carsten, do you want to? I'll come back to you, Richard, in a minute. Carsten, would you like to?
Well, just very briefly, at this point, you could say that this you can't really do that yet. And this is one argument for that. While there be some people trying to have special coins that are privacy preserving, this could be a reason that they might be more difficult to get normalized and regulated. So I don't think you can guarantee that. I'm pretty sure.
Oh, Richard, do you agree?
I'm afraid, Carsten, I don't agree with you. There are two very well-known companies, Elliptic and Chainalysis. Chainalysis is used by the FBI to actually track criminal transactions on the Bitcoin network, and actually was involved in bringing down the Silk Road website and tracking all of the Bitcoin that was used in those transactions. Now, with what we're seeing from FATF, the global KYC and AML regulator, with what's referred to as the travel rule, which means that a virtual asset provider, a service provider like ourselves, needs to actually not only KYC everybody on our platform, but we also need to KYC all the wallets that they're effectively sending to. So suddenly what you get is a much bigger footprint across the whole place that allows these regulators to actually have very granular views of what's going on the Bitcoin network and who's involved, and everything being linked together. In fact, one of the differentiating propositions of Equos, our exchange, is that every single coin coming onto our platform is checked through both elliptic and Chainalysis to make sure that it hasn't been used in any terrorist financing. Because again, to the point, and obviously the reason for the question, any institution wanting to look to buy this does not want to be buying coins off a terrorist or off a transaction that's been used in a terrorist transaction or a money laundering transaction.
Happy maybe to add some data points here as well. I think to what Richard mentioned, just to put things on a data perspective. Today, according to the latest data, we have only 0.34% of crypto transactions are linked to illicit transactions. And by the way, 50% of that are Ponzi schemes, have nothing to do with crypto, right? That's fraudulent activities. So that's one data point to note from that perspective, right? Second thing is actually, as we know today, in a traditional banking system, and that's relevant for any treasurer, despite all the efforts we do on anti-money laundering, we're able to capture less than 1% of laundered transactions. And according to the World Bank, the amount of money laundered to traditional financial ecosystem today is anywhere from 5 to 7% of global GDP. That is $800 billion to $2 trillion. Again, if you want to launder money, buy drugs, do anything illegal, cash is still the best way. When I go to the bank, it's very difficult to know where this is coming from. With Bitcoin, I'm not talking other cryptocurrencies, every single transaction is actually traceable. That's why actually on the market, there's even a premium on what we call virgin coins, which are newly minted coins that have a 10 to 15% of premium to them. So I think that's one thing we have to bear in mind on that perspective. The dilemma actually for a lot of crypto companies, including Richard, is yes, you have these tools. How far do we go? In the same way, when I get this in the bank never asked me that much more questions on where this banknote was used before. How far do you go? Because we know the history of the entire crypto transactions from the time the birth of that coin was mined. Yes, there are privacy coins, but most regulated exchanges are not even listing them. So the usage of privacy coins is actually quite limited for that perspective.
Okay, thank you, Henry. Francois, one for you. Do treasurers generally feel sort of nervous that the Bitcoin they put on their balance sheets, the more Bitcoin they have, the more likely their share price will be tied to the movement of Bitcoin price and not actually the overall company's performance, and maybe it will reflect negatively on them to external parties?
Yes, of course. Again, it's a bit counter nature because we try to preserve the cash and to maximize the return on the excess cash. But in the case you invest in cryptocurrency, and if we have big swings that could penalize a company, as you rightly say, if you're a publicly listed company, it could impact your share price, and therefore treasury could be pointed out. And again, we are not traders, we are not supposed to do that, and we are not incentivized for doing that. So it's why a lot of corporate treasurers, when we talk about money market, and I fully agree with the point we made about money market funds at the moment. So they say, okay, if it's negative interest rates, it's negative interest rates. So we live with that, and they don't want to take any risk, and they don't care about that because they consider that they are not really incentivized to invest in other assets. So again, that it's why I mentioned, so it should be done, but maybe gradually and reasonably, depend on the portion we will invest. The same with your own portfolio. If you invest in, I don't know, 5-10% in gold, it won't be 50% in gold or in commodities. So it's just a question of proportion and going gradually to potentially increase your all-in return and boost your alpha for your old portfolio of excess cash, but certainly not to invest too much, because we also need to assess what kind of volatility we can tolerate in our balance sheet and get the agreement from the CFO that he could live with that.
Yeah, absolutely. All right, we'll take a couple more questions, seeing as there are so many. We'll try and wrap up by 10 o'clock. There's a comment here that's quite interesting saying Fidelity have recommended an investment strategy of up to 5% of total assets in Bitcoin. What percentage do you see appropriate for a corporate treasury? And I'm going to roll this in with another question, which was, do you envisage corporates holding physical Bitcoin or having exposure via derivatives and structured products? So Henry, I saw you kind of nodding along there. If you've got any comments to add?
Yeah, I'll let Richard share on the percentage on the derivative element, but I'll say that actually when we're looking at it for many, again, let's give an example of what a lot of these experts are recommending, right? So if you look at some of these investment banks, they're recommending that companies, individuals to hold, let's say, 2.5% of their portfolio in Bitcoin. And the data shows that actually both on a risk-adjusted basis and an absolute basis, it improved returns from 164 basis points. Again, that is really more on the investment side, of wealth preservation, and so on and so forth. On the question I think any treasurer needs to ask himself or herself on when it comes to crypto is obviously first should go stable coins for the average payment, the reasons that we mentioned, the cost savings. On Bitcoin, it's really on a macro view, right? If you look at why Tesla did it, why May2 did it in Asia, and why yesterday actually WeWork announced that they'll accept Bitcoin and they'll be holding it on their balance sheet, is the argument that Richard was making at the beginning, whether there's a risk of currency devaluation, inflation, and so on and so forth. So I think you kind of need to have this view, depending actually where your obligation, your liabilities are from that perspective. Again, I think whether regardless of your answer, you need to have a point of view. And this is the big difference, because you may hate Bitcoin, you may love it, you may think it's a scam, you think dollar is going to be totally fine. But I think you need to have a view now, unlike a couple of months ago, because of what has happened. And I think this is why these things are quite useful.
Yeah.
On the derivative side, I don't know if Richard, you want to comment on the physical versus synthetic side?
Sure. Yeah, look, I mean, I think in terms of derivatives, it's more a case of if they don't want to actually go through the trouble of holding the physical asset, which, you know, it does come with complications. But in these exchange traded funds or futures that we see outstanding, you do end up paying quite a considerable difference on a funding basis or on an annual fee basis. So it obviously removes a lot of the pain. But now that you have providers in the space like ourselves and, you know, a few others that can provide you a very solid custody solution, it does actually provide you a much better solution in terms of thinking about what you can then do with that asset. Because you can actually, again, like the stablecoin argument that we talked about with Henry earlier, in terms of the yields that are being provided, you can actually get yield on your Bitcoin as well. And you can use that within a custodian like ours, which suddenly becomes quite a differentiator. I mean, the yields are not anywhere near what you're seeing on those US dollar stable coins, somewhere closer to 2 to 3% on Bitcoin.
But still
interesting. And certainly when you're thinking that you're probably paying somewhere in the region of 2 to 2.5% to have it all bundled up in a fund for you, like a Grayscale or a CoinShares. We are going to be offering that. We're going to have a Zetra listed ETP in the next few weeks, which will obviously come with a lower total expense ratio than those competitors.
Okay, good stuff. All right, final question, and then we'll do a little wrap up. Carsten, one for you. What would cause mass adoption of crypto assets? What's going to kick us over the line? You're on mute, sorry.
The voice of 2020, you're on mute. So this is, of course, I mean, I think the reason why a lot of regulators, in particular the French one, barked when Facebook's consortium Libra was announced, was exactly that when the big digital platforms, they start adopting it. So PayPal's announcement, for example. So there needs to be a driver. And I think that's to link back to what I said before, I think mass adoption is not going to primarily be in the retail space. Maybe for retail investors, but not for C2C or B2C transactions. I think the most important thing is mass adoption with large corporations, whether internally in their own platform. So if Libra had worked, then you can say if you're a WhatsApp user or Facebook user or an Instagram user, it will be like Bitcoin internally. But for all the companies in the consortium, this will be much more like a very good way of transferring money within the corporation or between corporations within this network. And I think this is this is what's going to drive the adoption. Is really the you can say the wholesale space, not the retail space.
Okay, awesome. All right, in the interest of time, let's just do a very quick wrap up for everyone. So same question to all of my panelists, just a very short answer. What's your key takeaway for our participants today from today's session? And in one word, yes or no, are crypto assets a viable treasury investment at this point in time? Carsten, your key takeaway and your yes or no.
Well, my yes or no is a maybe. I'm not an expert on treasury, so I'll have to sit on the fence.
There's always one.
So I think the key takeaway I would provide is that whereas on the open internet we think there's one network, whereas there really isn't. It's a network of networks. Whereas here it really is a competing infrastructure. So when you buy into a crypto asset, you don't only buy into the coin or the token, you buy into a community that manages this and the digital network that is linked to. So what's really important is when you invest in this, as also Henry said before, you need to understand the whole package. It's not enough that you just think that Bitcoin is this or Ethereum is that or Dogecoin is this. It's really the most important thing is for you to understand that community maintaining that network. And I think there are many other solutions that are distributed ledgers that are not only based on blockchain, like Hedera, for example, with what's called a hash graph. And I think it's really important to put a little bit of time aside to understand this before jumping into my maybe.
Absolutely. Great stuff. Thank you. And Henry?
Absolutely. I think the one piece of advice is education. Again, you may love it, you may hate it. You have this intellectual duty to at least understand it. Again, I gave you the tips of how you can do this. It's very easy these days just to learn yourself and do it. If it has a role for corporate treasurers, I would say yes. But also depending on what is, it really depends on the particular situation you're in, whether it's a stable coin for the payments and so on and so forth, or if you have the view as a hedge against currency devaluation, substitution of Bitcoin. So I think if this needs to be on top of your agenda, whether you like it or not, you need to spend some time on it.
Got to have a position on it. Great stuff. Francois, key takeaway in your yes or no position?
I would say no, or I would say not now, but I'm convinced it will come, and it's something of just a question of timing, I would say.
Yeah.
We need more certainties from the corporate side, so easier access through platform, answer to some of the questions we have addressed today, maybe more regulation or just certainties about the organization. And again, the central virtual currency could certainly help. So it's promising, providing we accept also a certain inherent volatility, and maybe volatility will be reduced over time. It's a new asset class, but we can imagine to make payment or to receive payment, and we need to consider that, as I mentioned. So hedging, interest rate, liquidity, way to automate payment, etc., are a key issue we need to answer to prior to invest in such assets. And again, as mentioned by Henry, I think that education is quite important. Education of yourself, of your team, and also to communicate to the management to make sure that what they want to do and they agree to do. So a couple of % of investment to start and to test the water would be certainly something that I would recommend, and try to see if it may be useful for corporate. And then to envisage what are the technical issues, because we need to integrate into our TMS, etc., and make sure that our IT system will also support this kind of new asset. I'm not sure that all the systems are ready for that, but it's coming. So it's a revolution, but it won't be, as I mentioned, a hard revolution. It will be a soft revolution. We need to start now and to consider and contemplate now.
Great stuff. Richard, final words from you, please.
Sure. Look, I think in terms of an allocation, I agree with Henry. It completely matters where you are as a corporate, what your cash flow looks like. You've got examples in MicroStrategy where they went 100% allocation to Bitcoin. You've seen Tesla do sort of a 7% treasury allocation to Bitcoin. And both of those people, they obviously control their company pretty fully. They are visionaries. They could be construed as being slightly off the wall and crazy. What I would point people to is probably not those two individuals. I'd probably point them to the bond investors that have started to move into this space, because you've got Paul Tudor Jones, you've got Stan Druckenmiller, and now Bill Miller as well, all moving into this space. Why are they moving into this space? They understand debt cycles. They understand what is happening to money and what needs to happen to money to make sure that we don't go through a horrific debt crisis. So if you're sitting on bonds, you are going to get destroyed in what's coming. And if you're not looking at how to manage or at least de-risk your exposure to fiat currencies and maintain the value of that treasury holding, then you need to consider Bitcoin and you need to consider other stores of value.
Yeah, brilliant. Well, thank you all so much, panelists, for sharing your insights on this topic. Thank you all for listening. Please keep an eye out on the TMI website for more information on this topic, and please get in touch with TMI or the Diginex team if you'd like to find out a little bit more. Thank you.
Thank you. Cheers.
Thank you very much, everyone.
Thanks for having us. Thank you very much.
Thank you. Take care.